This is the Clear Money Talk podcast, offering up creative solutions for your retirement future through education, choice, transparency, and empathy. Now, your host, CEO and founder of Clear Financial Partners, Tim Clairmont, and co-host, Tyler Andrews.
Hello. Welcome to Clear Money Talk. I'm your host, CEO and founder of Clear Financial Partners, Tim Clairmont. And as always, our wondrous co-host, Mr. Tyler Andrews.
Thank you, Tim, for the introduction. You know, it's nice being introduced in life, you know?
That's true.
It's like you walk into a room and, you know, it's got like music going behind you. It's like...
I should have been like, doing some kind of like really cool background noise for you. So it's like, here comes Tyler.
I'm all for it.
Yeah, right. No, anyway, but
it's fun to be here.
There's a word for that person who used to introduce famous royal guests. It's called a herald.
A herald.
I always thought like not herald like HAROLD, but HER, I think ALD or something.
Got it.
HEROLD. Anyway,
they would have like the trumpet. And,
yeah, exactly. There was like entering in is Tyler Andrews.
That.
So
thank you. I'm here, and I'm mostly energized. You might hear it in my voice. I'm a little sick still.
Yeah.
But I'm getting over it. I'm on the other side of it. I was a little cattywampus last week. I was really off kilter with being sick, but I'm back and I'm here.
That's good. Well done. And you get credit, Tyler, for integrating in the word cattywampus.
Thank you.
Yeah, we did just Tyler used that completely perfectly as he was referencing as pin in one of the previous episodes was a little bit askew.
Yep.
And rather than saying askew, he said it was a little cattywampus. And I was like, oh, what a great word. To which we said, all right, we'll see who gets that in first. And Tyler clearly won. So
that's all right. Maybe you can get it in somewhere else in the podcast.
Yeah, perhaps it'll come up. So then again, it just depends. It depends on what our topic is, which
that's true.
No idea what our topic is today. What are we talking about? What's Clear Money talking about today?
This is going to be a fun one.
Okay.
We talked about this recently as far as one that we wanted to record again. We recorded it once, and we're going to be recording it again, second time in the Clear Money Talk podcast room. Listeners may not have heard it, but we sure have heard it.
Okay.
And it's going to be a good one. So the topic of the day is...
I have a feeling I know where this is going now.
The topic is Bitcoin, blockchain, and the bigger picture. Is it right for me?
Got it.
So
so cryptocurrencies, Bitcoin, blockchain, and all of that good stuff. So I'm excited to talk about this. In the past we did record one. It was a couple of years ago, and so I think that the compliance elements associated with cryptocurrency made it a little challenging for us to air that particular episode at the time. It's certainly come a long way since we recorded that. I think a couple of years ago. I mean, we now have ETFs, exchange traded funds, that are dealing with Bitcoin or Ethereum. Those got approved essentially in late 2023. So now here we are, and it's been about a year and a half. We've seen some exchange traded funds out for cryptocurrency, and obviously Bitcoin and other cryptocurrencies have been around for a little while now. I'm not going to say that they're proven or been around for a very long time. They're certainly speculative. They're certainly aggressive, and I definitely have opinions related to that. But let's see where we're going to go. I'm sure that we have some specific ideas in mind as far as questions and comments.
I'm thinking, let's stick to the topic of is it right for me? I think we'll talk in generalities. None of this is should be misconstrued as recommendations. We're just here to educate, talk about what it is. I think so many times we get asked, what is cryptocurrency? Like, how does it work? What does it do? And I don't think there's any true cryptocurrency experts out there because it's such a complex.
Yeah, there's some self-proclaimed ones that would like to say they're cryptocurrency experts, but how much of an expert? I don't know. Not to say that they're not experts.
That's true.
But it is. It's a relatively new construct and something a lot of our clients really don't know anything about, and a lot of the people that are listening probably haven't really even heard much about it, other than you've heard it. And you're probably wondering, I don't know, what is that? And is that something I should be participating in or not? A lot of people made a lot of money in Bitcoin and other cryptocurrencies if they were early adopters and invested in it when it was a real flyer as an investment strategy. And yet there are also stories where a lot of people lost a lot of money as the cryptocurrency has gone down significantly. And if you dabbled outside of Bitcoin, there are many cryptocurrencies that went belly up. People put money into them, and then they lost everything. So it's important to recognize that as well.
Yeah, I think many investors have jumped in strictly for reasons of FOMO, fear of missing out, and not strategy or plan.
Yeah, that's fair.
And I think that's where I want to talk about in this podcast is, I can understand the fear of missing out because every headline is on the news, it's on social media, you hear your neighbors talking about it, and it makes you feel like you're missing out on doing something that's very important. Like, you don't want to miss out on something huge, but at the same time, with anything when it comes to your money, your time, your investments, your well-being, strategy and plan is so crucial to understand what you're doing and have a purpose behind it. So I want to talk about, crypto's everywhere, but should it be in your plan? What most crypto investors are getting wrong, so we can talk a little bit about how some people are going about it and how others are going about it. We can talk about how crypto could potentially have a role in your financial plan, what that might look like, and then we can also get our take on it and how we feel about it, where it makes sense. And then also maybe, Tim, you can just hit on, for the listeners that are like, yeah, I keep hearing cryptocurrency, but I don't know what it is or how it works. Maybe we could give them some general idea of what it really is at its core.
Yeah, I think that it's probably best for us to start there as far as what it is and how it works, and just kind of go over some of the basics, because a lot of people are like, I think that's a good place to start, frankly. So
what if we did that at the end, though? They're like, okay, I still don't know what it is. They're just talking about it. Let's start with that.
Smart. Look at that wisdom of ordering things. Okay, so cryptocurrency. So what it is. Now, I want to, I don't know, there's a lot of caveats that we're articulating. Clearly, they're there for a reason. The reason we're giving you these caveats is because it is speculative. That if you put any money in cryptocurrency, you need to understand there's a high probability, or a high possibility at least, that you may lose it all. And therefore, you need to make a decision as to, is it right for you, is it not right for you? I don't know. I mean, we have some clients that invest a little bit of money in cryptocurrency. We have some clients that have invested a lot of money in cryptocurrency. And most of our clients haven't put any money in cryptocurrency. And there's nothing right or wrong about any of those choices. But what is, I guess, cryptocurrency and Bitcoin in this concept? Essentially, and this, again, I'm not an expert on this. I'm just trying to articulate it the way I understand it. There is this, a limited amount of, let's just use Bitcoin as an example. There's a limited amount of Bitcoin that is out there. And there was a computer software that was essentially created to release a certain amount of Bitcoin over a period of time. So imagine that you have this giant mountain that has something equivalent to gold or whatever inside of it, but there's a limited amount of that gold. There will never be more than 21 million Bitcoin on the planet, because that's the way it's built. So you have this mountain with 21 million Bitcoins inside of it. And initially they released a certain number of Bitcoins. And I don't know how many it was. Maybe it was 5 million or 10 million or whatever. But that was the amount of Bitcoin that they released to the public. And people could purchase that Bitcoin through what are called digital wallets. Basically, it's an online way of storing your ownership of Bitcoin. And one of the great ingenious innovations that occurred at the creation of Bitcoin was what's referred to today as blockchain technology. And blockchain technology is basically a way to publicly, transparently have encrypted ownership so that it can't be taken from any other individual. So if you own the Bitcoin, nobody else can take it from you. Now, they could impersonate you by getting your username, your password, and then move the money somewhere else. So that's why you have to protect your username and password so carefully when you have cryptocurrency that's held in a digital wallet, and that becomes a big deal. Also, if you lose your username and password and everything else because it's tied to your digital wallet, and if you can't remember how to access it, you may have forever lost access to that cryptocurrency. So that is another thing to be aware of. A lot of innovations have come out since Bitcoin first came into existence to make these digital wallet a little bit easier and also a little bit more visible to the government. Because if you make money in any kind of cryptocurrency, Bitcoin, Ethereum, anything else along those lines, then whatever the gain is that you experience, if you theoretically, let's say you invest $10,000 into something like Bitcoin and it grows and it's worth $20,000. I'm not saying that's going to happen, but let's say it did. You made a $10,000 capital gain. As soon as you sell the Bitcoin, you have to pay taxes, long-term capital gains taxes or short-term capital gains taxes, depending on how long you held it, on that $10,000 gain. Similarly, if you paid $10,000 for it and it went down and you sold it and you got out and it was worth $5,000, you could report that capital loss of that $5,000 loss in that example on your taxes as well. A lot of people, when they first started using digital currencies, cryptocurrencies, they weren't reporting a lot of these things. They weren't reporting gains. They weren't reporting losses. And it became to some degree at the very beginning, almost a black market way of trading currency for activities that were not necessarily on the up and up. And that was some of the initial origins. It's certainly gone well past that now. There are a lot of people on the up and up. There's a lot of governments on the up and up that actually own Bitcoin and other cryptocurrencies. In fact, I think 5% of that mountain of Bitcoin, roughly, don't quote me on this, you can double check it, but as of the recording of this, I seem to heard that from a speaker a few weeks ago at a conference, that 5% of the total mountain of Bitcoin was owned by the US government. There are other governments that also own large percentages of Bitcoin, and that speaks to, is this a good idea or not a good idea? Well, our government's holding it. Maybe it is a better idea than not necessarily a good idea. I don't know. Maybe it's not. Maybe they're just diversifying their portfolio and trying to keep their toe in the water, and they can afford to do that because they're a giant government. So whether you can afford to do that or not is a whole other issue. So this Bitcoin in the beginning, maybe they had $5 million worth of Bitcoin. No, not $5 million, 5 million Bitcoins, let's say, that was out there theoretically. And then how do you access the other 16 million of Bitcoin? Well, they would have what's called Bitcoin mining. And so essentially, the software that we just discussed would create these really complicated math problems. And people would use computers to solve these really complicated math problems. And based on the complication of the math problems, as they solved them, they would be awarded some of the Bitcoin that was inside that mountain of Bitcoin. And that's how mining Bitcoin came to be. And as more and more Bitcoin were released, the math problems got harder and harder, and the amount of Bitcoin released got lower and lower. And now we're nearing the point where all Bitcoin, all 21 million, will be released in the very near future, and then there is no more mining. You're not going to be able to mine for Bitcoin anymore because it's all out there, and it's just being traded based on whatever people perceive value to be. And you might ask the question of, well, what is the value of it? And the value of it is only as good as what people are willing to pay. And in this particular case, you might say, well, that just doesn't make a lot of sense. And, at the same time, if you consider any currency nowadays, most currencies only have value because people believe they have value and they're worth trading for that value. And that applies to the US dollar. It applies to any other currency within any other country. We used to have the US dollar tied to something called the gold standard. That was like over 100 years ago. And so gold, you could actually tie the amount of dollars that you had to a certain amount of gold. And that had an inherent, seemingly intrinsic value. But that was eliminated a while ago, and so now you have this currency that's not tied to anything other than the confidence and the faith that people have in the quality of that currency. And the nice thing about Bitcoin and other cryptocurrencies is the efficiency with which they can be traded, and the cost associated with holding them, and that blockchain technology securing it, and the inability to counterfeit it really does make it a pretty high quality currency in concept. But as long as everybody has confidence in it, it could become an excellent store of value. And for that reason alone, it might be worth considering to have as a part of your portfolio. We do have an exchange traded fund available to our clients that can choose to invest a little bit of money in a Bitcoin ETF or a Ethereum ETF if they want to have it in some of their blue portfolios, as we've talked about previously. They don't exist yet in yellow portfolios, to our knowledge. And to learn about blue and yellow, go to our website, clairfp.com, so you understand what the difference is between the blue and yellow accounts that we have. Yeah. And I have been monologuing for a while, but I feel like there was some explanation that needed to be in there. I hope that's helpful for you as you understand the gist of how that works. And know that not all cryptocurrencies are the same. Bitcoin is that first original kind of gold standard, if you will, of cryptocurrency, because it was the first one that came out. It's got that limited 21 million. There are several others that tried to mimic that by creating their own software and creating their own currency. And that's just a totally different currency. And if people don't believe in it, it goes to worthless. And that's what can happen with other ETF or other cryptocurrencies and other potentially values that you might otherwise assign to what's called an NFT or a non-fungible token. We'll leave NFTs out of this for now, but fundamentally, just understanding that this is all dependent. The value associated with cryptocurrency is all dependent upon how many people believe that it's valuable. And if everybody believes it's valuable, then it's valuable. So, anyway,
thank you, Tim, for that explanation. I think a lot of our listeners are probably going to be really happy they sat through and listened to all that, because I think many of us, myself included, I've only barely scratched the surface of what cryptocurrencies, blockchain really is at the end of the day, and if it fits into a financial plan or not. And that's why we wanted to record this podcast, just to shed some more light on that as a whole. It is interesting to me, at least, that they're called currencies. it is currency, a store of value to some degree, but also it trades more like an investment. Where when you look at currencies like the U.S. dollar as an example, many want to refer to the U.S. dollar as an investment. It's a currency, it's a store of value, and the only reason that it holds the store of value is because people have confidence and faith in it. And that's not the same with cryptocurrencies, because the price is so volatile a lot of the time that the store of value could be X on one day and then Y 10 seconds later or the next day. It creates a unique situation. Is it a store of value? Is it currency, or is it more mimic an investment like a stock or a mutual fund or another form of investment?
That's an excellent question. I mean, considering that originally when Bitcoins were coming out, I mean, they were virtually worthless because nobody recognized them as valuable, and people would have them for, less than $10 a Bitcoin. I mean, less than $1 a Bitcoin when they first came out. And then people started to see value in the ease with which they could transfer the ownership of this currency, and the value rose because people were willing to pay more for the Bitcoins. And I will say, I heard a speaker talk about Bitcoin this is, as I mentioned previously, about a month ago. I was in Thailand listening to an expert, a self-proclaimed expert on Bitcoin, and he made some valid arguments that I found very interesting. He was talking about how currency has worked over human history. And there was an example of on an island many years ago, hundreds of years ago. There was this currency was measured in the form of this limestone. There was this special rock that represented currency, and there was a limited amount of this rock on the island, and so the local populace would trade that rock for currency as an example of currency, and they used it to trade different things. And imagine if you've got a chicken and somebody else has a hat, and somebody else has a coat, another person has a blanket, and you want to try to trade, and you have to assess some kind of value on these things. Bartering is inefficient. You don't know which one of those things is more valuable or less valuable than something else. So assigning a currency value to each of those items enables people to trade for more fair representation of value. That's why currency even exists in the first place. So when you have these limestone that represented the currency, then there was this gentleman who arrived on a boat from, I think it was England or some other place, and he saw they were using this limestone as this currency, and he knew of another island where there was like this unlimited amount of that limestone. So he basically went and he loaded up all this limestone in these boats, came over and bought everything, got all that stuff from them, and the currency became worthless, and he bought out everything that was there because it was easy to replicate that form of currency. Nowadays, with the U.S. dollar and other currencies, they put so much work into the technology associated with making those hard to replicate that it does create this element of, well, it's really hard to replicate, and there is a finite amount. But the governments are also able to print additional volumes of this currency. So on a yearly basis, most of the high-quality currencies will print and add about 8% per year to the money supply. So if you take, theoretically, this finite amount, and then you add 8% to it, it's going to decrease the value per dollar, if you will, in that example. And that's part of why we end up having inflation on a regular basis. Some of the high inflationary countries, you'll actually see them printing as much as 14% or higher of the currency. And as they add more currency to it, that's when you have all these really extreme inflationary challenges where stuff starts to cost a lot more than it used to cost. One of the things that I think is particularly unique and awesome about Bitcoin is that it is a finite number, that there's nobody that can just create more. The software caps out at the 21 million. So, many investors are looking at it as a store of value because at least at a minimum, it's not having extra Bitcoins created. There's a finite amount, unlike traditional currencies. So that's part of it. And then the more valuable, the easier it is to trade, the easier it is to protect against theft, and the easier it is to ensure the inability to replicate. The more valuable and desirable that particular form of currency is. And the speaker that I listened to about 4 or 5 weeks ago in Thailand was talking about how specifically that there has never been a more efficient form of currency than Bitcoin, as long as everybody continues to see value in it. And that is part of his rationale for why he recommended leaning into it. At this time, it's so volatile. I want to share a story on the other side of the fence of this.
Yeah, please.
About 2000 and think it was about 2018, I decided I was going to go ahead and put a little bit of money into Bitcoin. I went to Clackamas Town Center, there's a local mall. I saw a little ATM machine that showed distributing Bitcoin, and I was like, man, if they got ATM machines distributing this Bitcoin, maybe this thing's going to be around for a little while. And it took me forever. I used Coinbase as far as an alternative for those digital wallets because I didn't want to have to think about it. It was pretty mainstream, so I used that, paid the transaction fees, and it took me a while. I also heard another speaker at that time say, you know what, Tim, everybody in this room could probably afford to lose 1% of their net worth. So I looked at 1% of my net worth and thought, yeah, I could probably afford to lose that. So I decided to put that into Bitcoin, and it took me like several months to just kind of get it in there and get vetted and be able to get it set up. And then I watched that value go up a little bit and then go down a lot. And it went down to like half, maybe even 1/3 of what I put in. And I found myself watching it every day, like just logging in just to see what the value of it was every single day. And then eventually, many years later, 3 or 4 years later, I think it went up to twice what I had initially paid for it. I sold it, I walked away, and I was like, that's I'm done. I thank you very much. But fundamentally, did I double my money? Yes. Was it stressful as heck? Yes. It was over a 3-year period of time, and it was just crazy stressful. I could have easily lost had I sold at a lower point, or had the currency gone to zero, which could have happened too, especially if I dabbled in something other than Bitcoin. Many other currencies went to zero during that period of time. And if I could have all those minutes back that I spent staring at the frickin' screen getting those updates, I probably would have made way more money than the investment performance was. Just be aware that it is an extremely volatile, speculative investment still, and it's, if you're going to get involved in it, anticipate that kind of volatility is likely to be there.
Yeah. Well, thank you for sharing a personal anecdote. As far as that helps to put things into perspective, and if I'm hearing correctly, Tim, I'm hearing that cryptocurrencies can have a role in a financial plan, but people should maybe look at it more as a spice and not the main entree.
Ooh, that's a good
if you will.
Yeah, great way of looking at it. Yeah, it's the sizzle on the steak.
It's the sizzle on the steak. It's not the steak.
Not for me. There's a handful of people that would argue it's the steak, but in my opinion, I think it's more the sizzle than the steak. And if you want to have a little portion of your portfolio in it, maybe 1 to 10% of your investable net worth, I think that's reasonable depending on the investment objectives of the client, how much they can afford to take that kind of risk. In general, I wouldn't go above 10% of in any one stock or in anything as volatile as one cryptocurrency either.
Yeah.
But I do know people who are worth tens of millions of dollars that have anywhere from 70 to 100% of their net worth in Bitcoin. So know that there are stories of certainly people that are very, very smart people that are putting a lot more in it. There are also very smart people out there that have nothing in it, and there is no right or wrong. You just got to make your own choices.
Yeah, I think you have very stark differences, and finding the neutral ground between those two is a lot harder right now. People have either a very strong standpoint for or against it, and not many people kind of in between. I heard a quote also at a convention recently that the answers to problems are always clear when you look back on things. And it's so true. It's like, oh, well, of course, people, of course, should have been buying that stock back in 2001 when the .com and all that was going on. And we're going to look back maybe in 30, 40, 50 years and be like, oh, of course, people should have been purchasing cryptocurrencies back then. Like, why weren't they? If I was, alive at that time, I would have been putting all my money into that thing. But we're here right now. We don't have those answers. So all we have is, we have to look on based on what we know and what we've seen happen historically speaking. And, past performance doesn't guarantee future results, disclosure, disclaimer, and all that stuff. And we have to just try to make educated decisions based on what we know and what we think. And that's all we have to go off of.
And they may say the opposite, just to give you the opposite. 50 years from now, you may look back and they may be like, what were those people doing? Putting that money into that crazy stuff, that cryptocurrency. Did they know that was worthless? And that could be the case too. And so I don't want to paint the picture, one way or the other. We still don't know, I think, at this point.
Yeah.
But anyway, I do think I'll probably work myself to get back to that 1% of my net worth again into it at some point. That's probably where I'm heading, and I could maybe go up to higher than that at some point as well. But I personally will probably not go above 10% of my net net worth pretty much ever. I mean, unless it just takes off so much that it becomes 10%. That's the other thing. A lot of people that have a lot of Bitcoin might have gotten it many, many, many years ago. And when they got it, it might have represented 1 or 2% of their net worth, but it went up so much that it became a much larger portion of their net worth, and they just haven't sold it yet. And that's a good thing to be aware of too. Jumping in at such a high percentage of your net worth is not necessarily how most of the Bitcoin millionaires actually got there. They did it with a little bit. They just did it early, and it went up so much that it became a much larger percentage of their net worth. So, just be aware of that as well. Yeah. Anyway, what do we have left to cover that's on our list? I
think we've done a good job of talking about what it is, how it works. We keep referencing Bitcoin, but that's the only reason we're saying that is it makes it easy to comprehend kind of what we're talking about. There's thousands of different cryptocurrencies that exist. Bitcoin is just the most mainstream known one, so that's why we're using that as an example. So, Tim, you've talked about blockchain, Bitcoin, cryptocurrencies. We talked about usually where it might make sense to consider if you are considering it. We've talked about a lot of people have jumped into it based on FOMO, fear of missing out. And I think with anything in life, like we said earlier, having a plan and understanding what you're doing is pinnacle to make sure that you don't have a disappointment, Yeah. And I think that's the biggest crutch of this entire podcast is do your research, understand what you're doing, and if it makes sense for you, cool. And if it doesn't, it's also cool.
Yeah.
And if you need more insights, reach out to somebody that that you trust, that knows more about it than you do, or do your own research by buying a book or going online.
Yeah. Actually, I want to say that was a really well summed up summary of everything, and I think I'm going to just encourage us our editor to go back and say that was just the answer.
Okay.
So I'm good with that. What you just said
I'm happy with that.
Was just the answer, and on the end of that just the answer, I want to say this is a complicated enough podcast. I would strongly recommend if you're trying to get just the answer, you're not going to get the detail that you're going to get out of the full version of this.
No.
You should really listen to the whole version of this particular podcast.
Yeah.
Some of the other just the answers out there, you can get the answer and just have a good time listening to the whole podcast.
That's right.
This one, you really should tune into the whole version if you want to understand the answer. It's still not very long, I'm sure, at the end of the day.
It's not bad.
Yeah. So we'll finish it there.
Okay, I'm good with that.
Yeah. Let's move on.
Let's do some trivia. And in the spirit of the topic for today, our trivia follows suit. Trivia question, Tim. What was the first physical item ever to be bought with Bitcoin?
First physical item. So I know I heard stories about the, whatever $1 million pizza or something like that, because somebody traded like a bunch of Bitcoins for pizza back in it was like 10 Bitcoins or 50. People would say they were going to, trade for that. I don't know if that was the first item or not. I know that's been an interesting story, but I honestly have no idea. So since I have no other point of reference, I'm just going to go with pizza.
No, you are correct.
Okay.
You're correct.
That was the first physical item. All right.
First physical item was a pizza. In 2010, a Florida man spent 10,000 Bitcoins.
10,000 Bitcoins.
On 2 pizzas.
Oh my goodness.
Now that would be worth hundreds of millions of dollars.
Wow.
If you were listening to the podcast, I'm so sorry. I hope those pizzas were good.
Yeah. It's funny. A lot of people have that FOMO as they look back on things like that, and I think it's worth mentioning that realistically, if you'd had the 10,000 Bitcoins and you received those and you hung on to them, as soon as they were worth probably $300, you probably sold them because you're like, I got $300 for 2 pizzas. A lot of people have, and then they just got resold and bought and everything else all over the place, and it's a rare person that received these kinds of things and held on to them. What will be very interesting is the people who got Bitcoin 15 years ago or whenever it was first coming out and didn't even realize they had it, that still have that little digital wallet that they just kind of forgot about, that they have some ability to actually log in and get access to that. If you can find your old password or something, you may have some hidden treasure there that you just didn't even realize you had. That would be really cool. So I hope that happens to one of you listeners, and if it does, please call and tell us your story, because I couldn't be happier for you if that's the case. And totally, please understand, I'm not advocating that you should invest in cryptocurrency or Bitcoin or Ethereum or any of these other things at this time. You really need to make your own personal choice. It's still very speculative, and if you want to have a discussion about it, or you need a second opinion, or you want to more robust financial advisor that is as good looking as Tyler, you should give us a call. You can reach us at 503-579-1000. Or you can log in, check out our website, clearfp.com, and book a clarity call. We're happy to have a 15-minute chat with you and see if you might be a good fit.
Yeah, I love it. We could just end on that.
Yeah, there you go.
You could have ended just on the advisor's
the good-looking part. Yeah, I had a feeling that
good.
would get your ego going for the rest of the day. Probably even a week.
Yeah, that might carry on throughout the week.
You're welcome.
So,
you're welcome. All right. Thank you for joining us on Clear Money Talk. Have a wonderful, wonderful rest of your day, your evening, whatever time you happen to be listening to this. And for those international listeners, thank you for tuning in. I really appreciate it. We just met a good friend of ours from Australia who's been listening along.
Down under, listening to the Clear Money Talk.
That's
we
right.
appreciate you.
Shout out to Foggers. So thank you very much. We'll see you soon.
Tim Clairmont and Tyler Andrews are investment advisor representatives offering securities and advisory services through Cetere Wealth Services, LLC, member FINRA SIPC. Advisory services offered through Cetere Investment Advisors, LLC, a registered investment advisor. Cetere is under separate ownership from any other named entity. The views depicted in this material are for information purposes only and are not necessarily those of Cetere Wealth Services, LLC. They should not be considered specific advice or recommendations for any individual. Cetere Wealth Services, LLC exclusively provides investment products and services through its representatives. Although Cetere does not provide tax or legal advice or supervise tax, accounting, or legal services, Cetere representatives may offer these services through their independent, outside business. This information is not intended as tax or legal advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. Converting from a traditional IRA to a Roth IRA is a taxable event. A Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free and penalty-free withdrawal or earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59.5 or due to death, disability, or a first-time home purchase, up to a $10,000 lifetime maximum. Depending on state law, Roth IRA distributions may be subject to state taxes. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59.5, may be subject to an additional 10% IRS tax penalty. Investors should consider the investment objectives, risks and charges, and expenses of mutual funds and ETFs carefully before investing. The prospectus, which contains this and other information about the funds and ETFs, can be obtained directly from the company or from your financial professional. The prospectus should be read carefully before investing or sending money. A diversified portfolio does not assure a profit or protect against loss in a declining market. Dollar cost averaging will not guarantee a profit or protect you from loss, but may reduce your average cost per share in a fluctuating market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Although it is possible to have guaranteed income for life with a fixed annuity, there is no assurance that this income will keep up with inflation. There is a surrender charge imposed generally during the first 5 to 7 years or during the rate guarantee period. There is a surrender charge imposed generally during the first 5 to 7 years that you own the contract. Withdrawals prior to age 59.5 may result in a 10% IRS tax penalty in addition to any ordinary income tax. The guarantee of the annuity is backed by the financial strength of the underlying insurance company. Investment subaccount values will fluctuate with changes in market conditions. An investment in a variable annuity involves investment risk, including possible loss of principal. Variable annuities are designed for long-term investing. The contract, when redeemed, may be worth more or less than the total amount invested. Variable annuities are subject to insurance-related charges, including mortality and expense charges, administrative fees, and the expenses associated with the underlying subaccounts. Investors should consider the investment objectives, risks, and charges and expenses of the variable annuity carefully before investing. The prospectus contains this and other information about the variable annuity. Contact Clear Financial Partners at info@clearfp.com or 503-579-1000 to obtain a prospectus, which should be read carefully before investing or sending money. The cost and availability of life insurance depend on factors such as age, health, and the type and amount of insurance purchased. Before implementing a strategy involving life insurance, it would be prudent to make sure that you are insurable by having the policy approved. As with most financial decisions, there are expenses associated with the purchase of life insurance. Policies commonly have mortality and expense charges. In addition, if a policy is surrendered prematurely, there may be surrender charges and income tax implications. The target date of a target date fund may be a useful starting point in selecting a fund, but investors should not rely solely on the date when choosing a fund or deciding to remain invested in one. Investors should consider funds' asset allocation over the whole life of the fund. Often, target date funds invest in other mutual funds, and fees may be charged by both the target date fund and the underlying mutual funds. The principal value of these funds is not guaranteed at any time, including at the target date. Cetere does not offer any direct investments, endorsements, or advice as it relates to Bitcoin or any other cryptocurrency. This is for informational purposes only. Clear Financial Partners is located at 15573 Bangy Road, Suite 100, Lake Oswego, Oregon, 97035. For more information, please call us at 503-579-1000.